Let me be clear. If you're thinking about buying a house in 2026 and you haven't heard this warning, you're already behind. This is the brutal truth. The housing market is not your friend right now, and in 5 specific states, it's actively working against you. Prices look tempting, agents sound confident, and politicians are smiling for the cameras, but underneath that surface is a financial trap that will crush unprepared buyers. Most people won't like hearing this. If you ignore this, that's on you. Watch till the end, because this could change how you protect your money. Here's the shocking truth nobody wants to say out loud. Homeownership is no longer automatically a smart financial decision. That old advice your parents gave you, buy a house, build equity, retire safely, is outdated in parts of America. The system has changed. Taxes have changed. Insurance has changed. Migration has changed. Interest rates have changed. And yet people are still rushing in like it's 2005, thinking housing only goes up. That mindset is how middle-class families get wiped out. Let me call you out directly. If you're buying a house because you're scared of missing out because rent feels like throwing money away, or because someone on social media told you real estate is always safe, you are walking straight into a financial buzzsaw. Housing is no longer just about price. It's about risk stacking. And in 2026, risk stacking is how wealth gets destroyed quietly, slowly, and permanently. This is the brutal truth. A house is not just a mortgage. It's property taxes that never stop rising. It's insurance premiums that can double overnight. It's maintenance costs inflated by labor shortages and material prices. It's HOA fees that creep up every year. And most dangerously, it's political and economic decisions you do not control. You think you own the house. In reality, the state owns a piece of you. Here's the illusion I need to destroy right now. The illusion is that population growth equals housing safety. People say everyone's moving there, prices can't fall. That is lazy thinking. Migration without infrastructure, without insurance stability, without tax discipline, without job diversity creates fragile markets. Fragile markets collapse fast when conditions tighten, and conditions are tightening. Let me be clear again. We are entering an era where climate risk, insurance risk, tax risk, and employment volatility all hit housing at the same time. That has never happened at this scale before, and most buyers are completely blind to it because real estate agents don't get paid to warn you. Banks don't get paid to scare you. Politicians don't get elected by telling you the truth. I do. Here's what's really happening in 2026. States are desperate for revenue. They are bleeding money. Infrastructure is aging. Pension obligations are exploding. Disaster recovery costs are soaring. So what do? They squeeze homeowners, slowly at first, then aggressively. Property tax reassessments, special levies, insurance mandates, zoning changes, rent control pressure that kills investor demand and drags down property values. You think you're buying stability. You're buying into a fiscal mess. Most people don't calculate the real cost of ownership beyond the monthly payment. That's a fatal mistake. In several states, the true cost of owning a home is rising faster than wages. That means even if prices stay flat, affordability collapses. When affordability collapses, demand dies. When demand dies, prices fall. That's how housing downturns actually start, not with crashes, but with quiet suffocation. Let me ask you a simple question. If you buy a house today and your insurance doubles, your taxes go up 30%, and your home value stagnates for 5 years, did you really invest, or did you just lock yourself into a liability? Most people don't want to answer that question honestly because it scares them. It should. This is where the you versus the system reality kicks in. The system wants you anchored. A homeowner with a massive mortgage is compliant. You can't move easily. You can't take risks. You can't relocate for better opportunities. You're stuck paying no matter what happens. And when states know that, they push harder. Because where are you going to go? Let me be crystal clear. In 2026, flexibility is wealth, liquidity is power, and certain states are actively hostile to both. Buying a house in the wrong state doesn't just hurt your finances, it limits your future choices. That's a cost most spreadsheets never show. Now let's talk about interest rates, because this is where people really fool themselves. Even if rates stabilize or drop slightly, the damage is already done. Higher for longer rates reset buyer psychology. They cap what people can afford. That puts a ceiling on prices. In states where prices ran far ahead of incomes, that ceiling becomes a hard stop. You don't get appreciation, you get stagnation, or worse. And don't give me the argument that you're buying for the long term. That's what everyone says right before they need to sell. Job loss, divorce, health issues, family obligations, life happens. When it does, you don't want to be trapped in a market with declining demand and rising carrying costs. That's how equity evaporates. This is the dangerous mistake people are making right now. They're buying houses based on past performance in states that are facing future problems. They're looking in the rearview mirror while driving full speed into fog. That is not investing. That is gambling with leverage. Let me expose another uncomfortable truth. Some states have built their housing markets on fragile pillars: tourism, remote work, construction booms, tax incentives that can be reversed overnight. When those pillars weaken, the entire housing ecosystem feels it. Renters leave, investors pull back, builders halt projects, prices soften, but taxes and insurance do not go down. They go up to compensate. This is where people get crushed. They assume risk is evenly distributed. It's not. Risk is concentrated geographically. In 2026, buying in the wrong state is like buying stock in a company with massive hidden liabilities. The balance sheet looks fine until it doesn't. Let me say something most people won't like hearing. Renting can be a smarter financial decision than buying in a bad market. That doesn't mean rent forever. It means wait until the math works in your favor. Patience is a weapon. Impulse is expensive. The system pressures you to buy emotionally. Fear of missing out, social pressure, family pressure, the idea that renting means you failed. That is nonsense. Financial independence doesn't care about your ego. It cares about cash flow, risk, and optionality. Here's the insight you need to lock in right now. A house should serve your life, not control it. If a state's policies, taxes, insurance environment, and economic structure turn your house into a stress machine, you didn't buy security, you bought anxiety with a deed attached. In this video, I'm going to break down 5 states where buying a house in 2026 could be a serious financial mistake. Not because they're unpopular, not because they're ugly, but because the numbers, the policies, and the risks are stacked against you. Some of these states will shock you. Some are media darlings, and that's exactly why people get blindsided. If you're feeling uncomfortable right now, that's good. Comfort is how people stay broke. Awareness is how you protect yourself. Remember this phrase because it matters. Price is what you pay. Risk is what you live with. In the next section, I'm going to name the first state you should think twice about buying in. And when you hear the reasons, you'll understand why so many homeowners there are already trapped. Most people won't see it coming until it's too late. Let me be clear, the first state I'm warning you about is Florida. And before you get emotional, before you start typing angry comments, listen carefully. This is not about beaches, weather, or lifestyle. This is about math. This is the brutal truth. Florida in 2026 is one of the most dangerous places in America to buy a house if you care about protecting your money. Here's the bold statement. Florida real estate is no longer a housing market. It's an insurance market pretending to be housing, and that distinction will cost people fortunes. Most people still think Florida is a tax-friendly paradise. No state income tax, business-friendly headlines, population growth. Sounds great. But let me ask you something. What good is saving on income tax if your property insurance wipes you out? What good is appreciation on paper if your carrying costs explode faster than your income? This is the illusion Florida buyers are trapped in. They look at home prices and ignore everything underneath. Insurance premiums in many parts of Florida have doubled, tripled, or disappeared entirely. Companies are pulling out, policies are being canceled, deductibles are skyrocketing, and when insurers leave, lenders panic. When lenders panic, buyers vanish. Let me be very clear. If a house is hard to insure, it becomes hard to finance. If it's hard to finance, demand collapses. And when demand collapses, prices follow. This is not speculation. This is how markets work. Florida homeowners are already living this reality. Special assessments, mandatory roof replacements, new flood zone maps, updated building codes that force expensive upgrades. You buy the house thinking you're done. Then the bills start coming, and they don't stop. Here's the dangerous mistake people make. They assume insurance is a fixed cost. It's not. In Florida, it's a volatile variable, and volatile variables destroy long-term planning. You cannot budget for chaos. Let me say something uncomfortable. Many Florida homes are effectively ticking liabilities. One major storm, one regulatory shift, one insurer collapse, and the numbers no longer make sense. You don't control that risk. You just pay for it. And don't tell me I'll self-insure or I'll take the risk. Banks don't care about your bravery. If you have a mortgage, you need insurance, period. And if insurance becomes unavailable or unaffordable, you're stuck. That's the trap. Now let's talk about property taxes in Florida, because this is where people get blindsided. Rising home values mean rising tax assessments. Even with caps, taxes creep up. Local governments need revenue for infrastructure, disaster recovery, and emergency services. Guess who pays? You do. So here's the brutal math. Insurance up, taxes up, maintenance up, interest rates still elevated, appreciation uncertain. That's not an investment thesis. That's a stress test. Let me be clear again. Florida is not crashing tomorrow. That's not the point. The danger is slow erosion, death by 1,000 cuts. That's how middle-class wealth disappears quietly. Now let's move to the second state you need to think very carefully about in 2026, California. And yes, I know, people have been warning about California for years, but this time, the risks are no longer theoretical. They're structural. Here's the bold statement. California housing is being crushed by policy risk, insurance risk, and affordability collapse all at once. And when those forces collide, homeowners pay the price. Let's start with affordability. California is one of the most unaffordable housing markets in the world relative to income. That means demand is fragile. It depends on high earners, stock market wealth, and constant inflows of capital. When any of those weaken, the market softens fast. Now layer on interest rates. Higher rates have gutted purchasing power. Buyers who could afford a home 3 years ago are locked out today. That shrinks the buyer pool. Fewer buyers means less competition. Less competition means weaker prices. But that's just the surface. The real danger in California is policy volatility, rent control expansion, investor restrictions, zoning mandates, property tax debates, environmental regulations. These things may sound abstract, but they have real consequences. They scare capital away. Let me be crystal clear. Housing markets need confidence. When investors, builders, and buyers lose confidence, activity slows. When activity slows, prices stagnate or fall. And when prices stagnate while costs rise, homeowners lose. Insurance is another massive red flag in California. Wildfire risk has driven insurers out of entire regions. Policies are being canceled. Premiums are exploding. State-backed insurance programs are swelling with risk. That is not stability. That is a warning sign. Ask yourself this: if private insurers don't want the risk, why should you? Most people ignore this because they assume government will step in. That's dangerous thinking. Government intervention often raises costs, not lowers them. And those costs get passed to homeowners. Now let's talk taxes. California already has high income taxes. Property taxes may be capped, but local fees, bonds, and assessments add up. And as budgets tighten, pressure increases. Homeowners are easy targets. They can't move quickly. They can't hide. Here's the dangerous mistake buyers make in California. They assume long-term appreciation will bail them out. That assumption is no longer safe. When affordability collapses, appreciation slows. When people leave the state, demand weakens. When demand weakens, prices stop rising. And let me say this clearly, even flat prices are a loss when inflation is high and carrying costs are rising. Stagnation is not neutral, it's negative. Now, I want you to understand the psychological trap here. People fall in love with the idea of owning in Florida or California. They tie their identity to the location. That clouds judgment. The market doesn't care about your emotions. It only cares about numbers. Let me repeat something important. A house is not a trophy. It's a financial instrument. If the instrument is loaded with uncontrollable risk, you walk away. This is where the system plays you. Real estate marketing sells dreams, sunshine, lifestyle, status. What it doesn't sell is the downside. That downside shows up later, quietly, in your bank account. If you're watching this and thinking, this doesn't apply to me, that's exactly who it applies to. Overconfidence is expensive. Let me give you a powerful insight. In 2026, the most dangerous housing markets are not the ones already collapsed. They're the ones still pretending everything is fine while the foundation cracks. Florida and California share one thing in common: massive exposure to risks homeowners cannot control. Climate, insurance, policy, taxes, migration shifts. When too many variables move against you at once, probability turns ugly. This is not fear-mongering. This is risk management. And most people never learn it until it's too late. If you already own in these states, this is not a personal attack. It's a wake-up call. If you're thinking of buying, it's a warning. You don't get points for bravery and bad math. In the next section, I'm going to reveal 2 more states that most people completely underestimate. States that look affordable. States that look safe. States where buyers think they're being smart. And that's exactly why the danger is so high, let me be clear. The next 2 states I'm warning you about are the ones that fool smart people. These are not obvious disasters. These are not states people expect to hear on a warning list. And that's exactly why they're dangerous. The illusion of affordability is the most expensive illusion in housing. Here's the bold statement: cheap houses can be the most expensive mistake you ever make. The 3rd state you need to think twice about in 2026 is Texas. Now, before you lose your mind, understand this. Texas is not failing. Texas is growing. But growth without guardrails creates hidden risk. And Texas housing is loaded with hidden costs most buyers don't calculate. Let me destroy the biggest illusion first. People say Texas has no state income tax, so it's affordable. That is lazy math. Texas replaces income tax with some of the highest property taxes in the country. And those taxes are not theoretical. They are relentless. Here's the brutal truth. In Texas, you never really finish paying for your house. Even after the mortgage is gone, the tax bill keeps coming. Miss it and the state will take the house. That is not ownership. That is long-term rent to the government. Property taxes in Texas rise aggressively with valuations, and valuations have surged. Most buyers don't stress test this. They look at the mortgage payment and feel good. Then 5 years later, their tax bill has jumped thousands per year. That's real money. That's cash flow bleeding out. Now layer in insurance. Texas is not immune to climate risk. Severe storms, hail, flooding, heat damage, insurance claims are rising, premiums are following, and just like Florida and California, insurers are adjusting behavior. Higher deductibles, narrower coverage, more exclusions. Let me be clear again. Rising taxes plus rising insurance equals affordability erosion. Even if prices stay flat, the cost of living in that house rises. That squeezes homeowners. Here's another uncomfortable truth. Texas housing supply is massive. Builders responded aggressively to demand. That sounds good until demand slows. When supply outpaces demand, prices soften. That's basic economics. In certain Texas metros, inventory is already climbing. Price cuts are becoming normal. Builders are offering incentives. That is not strength. That is a market adjusting downward. Now ask yourself this: if prices stagnate or decline while taxes and insurance rise, what happens to your equity? It gets eaten alive. This is the dangerous mistake Texas buyers make. They assume growth guarantees appreciation. Growth only guarantees volatility. Appreciation requires balance. Texas markets are losing balance. Let me say this clearly. Texas is a great place to live. That does not automatically make it a great place to buy a house in 2026. Those are 2 different decisions. Confusing them is expensive. Now let's move to the fourth state. This one shocks people, Arizona. Here's the bold statement. Arizona housing is built on scarcity that may not hold and costs that are rising faster than incomes. Arizona exploded during the low-rate era. Investors, retirees, remote workers flooded in. Prices surged, construction followed. But the foundation of that boom is now under pressure. Let's start with water. This is not politics, this is physics. Water scarcity is a real constraint. As pressure increases, costs increase. Infrastructure upgrades, conservation mandates, development restrictions, these things affect housing values. Now add climate stress. Extreme heat impacts livability, insurance, and maintenance costs. Cooling costs rise, insurance claims rise, infrastructure strain rises. None of that is free. Let me be very clear. When operating costs rise faster than wages, affordability collapses. Arizona wages have not kept pace with housing costs. That creates a fragile buyer base. Here's the illusion. People think Arizona is still cheap compared to California. That comparison is irrelevant. The only comparison that matters is income versus ownership cost. On that basis, many Arizona markets are stretched. Investors played a huge role in Arizona's boom, and investors are not loyal. When returns compress, they leave. When investors sell, supply jumps. When supply jumps, prices fall. End of story. This is already happening in pockets. Listings are sitting longer. Price reductions are increasing. That's not a crash, that's a warning. Now let's talk taxes and fees. Arizona municipalities are expanding fees to fund growth. Development impact fees, local assessments, utility costs. These creep into ownership quietly. Most buyers don't notice until the monthly burn rate is higher than expected. Then stress starts. Here's another brutal truth. Arizona housing markets are extremely sensitive to interest rates. When rates rise, demand falls fast. That volatility is dangerous if you're buying near the top of an affordability cycle. Let me ask you a hard question. If you buy a house today and need to sell within 5 years, are you confident the next buyer can afford it at current rates? If the answer is no, you're speculating, not investing. This is the core mistake across Texas and Arizona. Buyers assume tomorrow's buyer will be richer, more desperate, or more optimistic. That is not a strategy. That is hope. Let me repeat something important. Hope is not a financial plan. Now I want you to see the pattern forming. Florida, California, Texas, Arizona, different states, same problem. Costs homeowners cannot control are rising faster than stability, insurance, taxes, infrastructure, policy, climate. These are systemic forces. You don't fight them, you avoid them. The system doesn't warn you because it benefits when you buy. Builders sell, agents earn, banks lend, states collect. You carry the risk. This is the you versus the system moment. You either think independently or you pay for everyone else's incentives. Let me be clear again. I am not saying never buy a house. I am saying stop buying blindly. Stop assuming past appreciation guarantees future safety. Stop confusing popularity with stability. Here's a powerful insight most people never hear. The best housing decisions are boring. They don't make headlines. They don't go viral. They quietly protect cash flow and optionality. Buying in an overhyped state during a risk-heavy period is the opposite of boring. It's exciting. And excitement is dangerous in finance. If you feel defensive right now, that's normal. Housing is emotional. It's tied to identity, family, and security. That's why people get hurt. Emotion clouds judgment. Let me ground this again. A house should reduce stress, not increase it. If your state's trajectory points toward higher volatility, higher costs, and policy uncertainty, that stress will grow over time. Most people don't realize they made a mistake until they try to sell. That's when reality hits. Low offers, long listing times, price cuts, carrying costs, draining savings. That's when regret shows up. The people who win are the ones who avoid the trap before they enter it. In the next section, I'm going to reveal the the fifth state. This one is the most underestimated of all. It doesn't get media hate, it doesn't get flashy headlines, but in 2026, it may be one of the riskiest places to buy if you care about long-term financial survival. And then I'll give you the framework to protect yourself, no matter where you live. Let me be clear, the fifth state is the one almost nobody sees coming, and that's exactly why it's dangerous. This isn't a flashy state, it's not constantly attacked online, it feels stable, it feels normal, and that false sense of security is how people get financially trapped. The fifth state you should seriously reconsider buying a house in for 2026 is Illinois. Here's the brutal truth. Illinois doesn't destroy homeowners with a sudden crash. It slowly suffocates them. People look at Illinois and say, homes are affordable here. That's a dangerous illusion. The purchase price is only the entry fee. The real cost shows up every single year in property taxes. Illinois has some of the highest property taxes in the country, and they keep rising. Let me be very clear. In Illinois, you never truly finish paying for your house. The mortgage may end, but the tax bill never does. Miss a payment and the state will take the property without hesitation. That's not ownership, that's permanent obligation. Why are taxes so high? Because Illinois is financially broken. Massive pension liabilities, chronic budget deficits, aging infrastructure, political spending with no accountability. That money has to come from somewhere, and homeowners are the easiest target. You can't hide. You can't move quickly. You just pay. Now layer in population decline. People are leaving the state. When residents leave, the tax base shrinks. When the tax base shrinks, the burden on remaining homeowners increases. That's a slow motion death spiral for housing values. Ask yourself this uncomfortable question. If people keep leaving and taxes keep rising, where does future housing demand come from? Who is the next buyer? And how much leverage will you really have when you need to sell? This is where homeowners get trapped. Prices stagnate. Sometimes they fall. But taxes continue rising every year. Even if your home value stays flat, you are losing money after inflation. That's a silent loss most people don't recognize until it's too late. Now let's talk about policy risk. Illinois is not friendly to property owners. Expanding fees, transfer taxes, regulatory pressure, rent control discussions, all of this scares investors away. And when investors disappear, liquidity dries up. Here's what that means in plain language. When you want to sell, there are fewer buyers, offers are lower, homes sit longer on the market. Meanwhile, you keep paying taxes, insurance, and maintenance every month. Time becomes your enemy. Most people make this mistake. They say, nothing dramatic is happening here. But listen carefully. Stability is not the absence of noise. Stability is balance. And Illinois is structurally out of balance. Now step back and look at the full picture. Florida is drowning in insurance risk. California is crushed by policy volatility and affordability collapse. Texas is bleeding homeowners through property taxes and oversupply. Arizona is stretched by fragile affordability and climate pressure. Illinois is quietly suffocating homeowners with taxes and outmigration. Different states, same outcome. Homeowners carrying risks they cannot control. This is the brutal truth most people don't want to accept. Housing is no longer just about location or lifestyle. It's about governance, demographics, and long-term cost trajectories. Ignore those forces and you pay the price. Let me be clear one last time. Housing is a risk management decision, not an emotional one. If a state's financial model depends on squeezing homeowners harder every year, you don't win by being loyal. You win by being cautious. Sometimes the smartest move is not buying. Sometimes renting is the more disciplined decision. Ego tells you to buy. Numbers tell you to wait. And remember this, one bad housing decision doesn't just cost money. It costs years. Years of stress, years of lost opportunity, years you never get back. If this made you uncomfortable, good. That means you're thinking. And thinking is how you survive financially in 2026. If you care about protecting your future, do 3 things, like this video so others hear this warning. Subscribe for real financial truth, not feel-good advice. And comment below which state you're in and whether you agree or disagree. and share this with someone who's about to buy without thinking, because one bad housing decision can erase a decade of hard work. In the next section, I'm going to reveal the fifth state. This one is the most underestimated of all. It doesn't get media hate, it doesn't get flashy headlines, but in 2026, it may be one of the riskiest places to buy if you care about long-term financial survival. And then I'll give you the framework to protect yourself no matter where you live.